I think a lot of this is already embedded. I mean, we've been talking about this for months. This was expected. The question is, I think, when we see earnings season, how is this really going to play out? And I think that's going to be an important part, because if costs to the consumer and to industrial companies are going to go up, that will be affected in stock prices. But at this point, it's still salvos going back and forth, and we really haven't seen the rubber hit the road, and I think that's going to be the important part.
Stephanie, do you think the market is betting that there's going to be a negotiation that takes place and that this doesn't fully come to fruition?
So I think that the market they expected the 10% hit, right, on the $200 billion, but not the 25% coming in January. If you add it up together, it's about 3 to 4% to earnings for next year. But at the same time, market
3 to 4% knock on the S&P 500 earnings overall
for next year. I think that's actually kind of manageable, quite frankly. But, you know, I think we have to think about, let's hear what the companies have to say. Let's see what kind of cost and restructurings they're going to do. And I just feel like at these valuations, the market multiple has gone from 19 times to 16 times this year.
So that's the impact.
So that's where I think we're already pricing in a lot of it. I mean, if we go the whole $500 billion, that's probably an 8 to 9% hit to earnings. That's much more meaningful. So we have to watch it and be careful. But I listened to what FedEx said last night. They said China's slowing a little bit, but they have pricing power, and they actually had a pretty good quarter X the compensation issue that you had mentioned earlier. So I think companies are ready, and they're handling it for now.
So I think the unintended consequence of something like this is we have to watch inflation.
Okay.
And if prices start going up, wages start going up, that could have an effect on interest rates as well, and I think that will be interesting to see what the Fed does.
How soon would something like that play in?
Well, I think to Stephanie's point, if we see 25% in January, that could be pretty quick, because if companies pass this on and it actually sticks, then you will see inflation, and actually the perception of inflation will cause interest rates to start moving, and I think that could be a fear for the market.
Look, this is a big difference if we're talking about 3 months, if we're talking about a year, if you're talking about 2 years.
Right.
How do you game that?
I think the market's telling you that in 3 to 6 months this is going to be over, and there's going to be some type of negotiation. But in the short term, you get a 3% hit. That could be a one-time, and there'll be certain sectors that will get hit more. So it's really a watch and see. But if it stays longer, and as you said, if the Chinese take a much longer view, this could have a longer term. You could get a flat to down market for even longer than we think.
And it's interesting what groups led yesterday. It was the cyclicals,
Yeah.
It was industrials, it was metals, it was energy, it was growth that got hit. So growth is actually a little bit more vulnerable. I still like a combination of growth and value, but the valuations for some of these cyclical names have already gotten hit since March, since February, March, since Caterpillar made those comments. The industrials are down something like 15 to 20% on average, and they have actually been implementing price increases already, and they expect by the fourth quarter to see a positive impact from the price increases that they have put in place. So I think that's why those stocks are rallying, because they have a plan in place.